Can you keep someone on your home payroll while they live and work in another country? Usually not for long. The moment a person does real work in a country, that country starts expecting payroll tax and often Social Security, usually from day one, and it does not care where the salary lands. At Aspirock, we use a 3-question test to spot when a cross-border setup is quietly broken, and by the end of this video, you can run it on your own team. Start with the idea that trips everyone up. Many countries now apply what tax authorities call the economic employer concept. The right to tax follows whoever benefits from and bears the cost of the work, not whoever signed the employment contract. So an employee of your home company who spends their working time serving a team or client in another country can create payroll obligations there, even though not a line of paperwork changed. The contract says one thing, the facts say another. Tax authorities read the facts. Here is the Aspirock 3-question test for cross-border payroll. Question 1. Is anyone spending real working time in a country that is not the one paying them? Question 2. Does a local team or entity benefit from that work or get recharged its cost? Question 3. Will any bonus or equity vest after someone has moved countries? 1 yes means the setup needs a proper look. 3 yeses usually means it needed one last year. Now the most dangerous myth in cross-border employment. At Aspirock, we teach the 183-day rule as 3 tests, not 1. The day count, the employer's residence, and who bears the cost of the work. The exemption in most tax treaties requires passing all 3. Under 183 days, an employer not resident in the host country, and pay not borne by a permanent establishment there. Fail anyone and the income is taxable, often from day 1. And if you do cross the day count, tax applies retroactively to day 1, not from day 184. 2 examples of how little the 183-day figure protects you. Sweden adopted the economic employer concept in 2021, and its real de minimis is 15 consecutive days, or 45 days in a year, after which a foreign employer must register and withhold Swedish tax. The United Kingdom expects pay as you earn from day 1 unless you agree a short-term business visitor arrangement in advance. The day count people rely on tells you almost nothing about either country. One nationality makes cross-border payroll permanently complicated. United States citizens are taxed by the United States on worldwide income wherever they live. The foreign earned income exclusion shelters about $133,000 in 2026, but it does not remove the reporting, and treaty protection never covers Social Security. That needs a separate totalization agreement, or contributions can genuinely double. If you employ American citizens abroad, get the structure right early. Their home country never lets go. Question 3 of the test exists because of trailing income. Equity and bonuses are taxed where the work was performed while they were earned, not where the person sits on payout day. Someone who spent 2 years of a 4-year vesting period in Germany owes German withholding on half that gain, even after moving away, and the employer may have to re-register a departed employee just to report it. Auditors love this one because almost nobody gets it right. When large multinationals send people on temporary assignments and keep them on home payroll, their tax advisors patch the gap with something called a shadow payroll. A second payroll in the host country that pays nobody and exists purely to calculate and report the host country's taxes. The name sounds murkier than it is. It is simply how a country collects payroll tax from someone who works there but is paid somewhere else. It works, but it is complex. It needs specialist tax support on both sides, and for most growing companies, it is a patch on a setup that should not exist in the first place. Here is the simpler answer. If someone lives and works in a country long-term, employ them in that country, with local payroll, local tax, and local Social Security done properly. That is what an employer of record does. Aspirock does not run shadow payrolls. We remove the need for them by employing and paying people correctly in the country where they work, in over 70 countries. And where a genuine contractor is the right shape, We run compliant gross payroll and contractor payroll, with the tax liability sitting where it belongs, with the contractor. If any of the 3 questions was a yes, the fix is in the description. The 3-question test, our shadow payroll explainer, and our payroll only versus employer of record guide.